Hello everyone. My name is Kamal Manocha. I represent PMS AIF World. Welcome to another interesting and intuitive webinar that we have planned for today, being a Friday. We have been maintaining this discipline of trying to learn new strategies, new approaches from young as well as mature fund managers, and we have been doing this on every Friday since last 3 years. And I'm telling you, this is a very real and very enriching experience. And in that stride, today we have one of the most young fund managers, who is going to discuss the modern day, the new approach of investing in the context of diversification as well as in the context of taxation. These two aspects bother investors a lot, and that is where we thought the new approach, the new style of investing, which is an answer to diversification as well as taxation in context of being very effective, is the subject that we will cover today. So to give you a detailed perspective on what is expected out of this webinar, we are going to discuss why investing outside India makes a lot of sense in the context of diversification, and what is that route which is available in such a manner that this is efficient from the grounds of taxation also. And to kind of discuss this aspect, we have Mihir with us, who belongs to Phillip Capital Ventures IFSC. IFSC is the name which Mihir was telling me is supposed to be associated with every company which has a genesis from GIFT City, which is the one of the elements of the topic that we have today, which we have been talking about. Investors want to know more about it, but we will discuss in detail today. So to give you background of Mihir, Mihir brings with him 7 years of experience. He did his CA in 2012, and then he has been associated with asset management industry for 7 years. Did his MBA from IIM Ahmedabad and is a 2020 batch. He's also completed his CFA, and he has certifications in the context of investment advisory exams also. So the fund manager is kind of young and very knowledgeable, educated, and obviously we would want to understand from him a lot of things today. And he has his background image which conveys that he's trying to talk something beyond India, and that is something which is interesting, and all of us want to hence hear him out. And just before he starts, I would also like to add that he's managing global PMS business, which is domiciled in GIFT City, and that is the context of this webinar, where I was saying this is something to do with diversification as well as efficient taxation. Over to you, Mihir. You have a interesting presentation. I have had a glance of that. Looking forward to the same.
Sure. So very good evening, everyone. Thank you so much for joining in on a Friday evening. I think it is indeed a very exciting time for me to be making this presentation, right now, especially with so much happening in the global markets. The first half of 2022 was, extremely volatile for investors. Okay, a lot of indices were actually in the official bear zone. We had geopolitical conflicts, we had inflation hitting decades high, we had monetary tightening by the central banks, which is underway. So on and so forth. So definitely there has been a lot of volatility. And of course, let me say that word, there has been a lot of correction as well in the markets. But amid this entire chaos, I still, through this presentation, would like to make a case for investing in the long term and thinking beyond the territorial boundaries of India. So why is it that one can consider global investing as a part of one's portfolio? So that is something that I would like to cover as part of this presentation. So I am working with Phillip Ventures IFSC Private Limited, which is a part of the Phillip Capital Group. As an entity, we are headquartered in Singapore and we have presence in 15 countries. Globally, we manage over 40,000 different products, and we have a total of $47 billion of assets under custody. We are servicing more than 1.3 million clients worldwide. Now, across all our regional offices, we are providing services across broking, institutional research, fund management across various asset classes. In India too, we have a very strong institutional presence. And particularly in India, we also have had a very successful track record for the India-based PMS, which is over 5 years old now. And of course, the newest addition is our presence in GIFT City. So, as was mentioned, that I am managing the global PMS business from GIFT City. We begin the discussion by asking a question that why should one consider international allocations? Today, investors are much more aware. They are much more informed. Okay, they are reading up a lot about what is happening outside. I think everyone really is talking about the U.S. Federal Reserve and the monetary action, so on and so forth. So the point is that there is definitely a lot of knowledge and a lot of curiosity which investors are blessed with. But if we really boil it down to numbers, this is what I would like to present. So what we have in front of you is the performance of the stock market benchmarks of select countries for the entire previous decade. So right from 2010 till June 2022. So that's over 12 and a half years actually. And of course, the blue shaded region is Nifty 50. Now, what we can see is that in the entire previous decade, on a CAGR basis, Nifty 50 has not been the best performing index. Of course, there have been a few years in which the Nifty 50 has been a clear outperformer. But as we'll see in the next slide, a major chunk of the returns has actually come from the developed markets, particularly in the second half of the previous decade. If we look at a 15-year view, okay, this is what we observe. So if one would have invested, let's say, 100 in the respective currencies of these countries and these benchmarks, then as at the end of 15 years, let's see what would have happened. Okay, so this is a 15-year horizon. The start date is 30th June 2007. But as of 30th June 2022, what we see is that the Nasdaq has been the outperforming index. Of course, there is Nifty 50 followed by the S&P, Dow Jones. But we also see that there are a few indices that have not delivered great returns. In fact, a couple of indices have actually been value destroying. So when it comes to global investing, selection of the right regions is also important. But question is global investing only about geographic diversification? Let's find out. Now, today, when we are looking at the markets, a short-term view is the entire volatility. Okay, we are, let's say, in a technical recession because the Q2 GDP in the US was negative again. So everyone is really excited about what will happen then in the next 2 months, in the next 6 months. Will inflation really be under check, or will monetary tightening be aggressive? Will it really push the economies into recession, so on and so forth? But if we really look at a very long-term picture, so we are in 2022, but if we really stare at the decades which are ahead of us, what we realize is that there is disruption happening across the globe. And amid these disruptions, there are businesses as well as countries that stand to gain from emerging trends. In the third point, for example, I have mentioned some select innovations across different industries. The point that I would really like to drive here is that today technology is not existing as a standalone sector alone, but there is technology disruptions across different sectors. So in healthcare, people are talking about investing in areas like neurotechnology, genomic revolution, medical devices. Financial services, I think everyone here is aware of cryptocurrency and the blockchain. There is decentralized finance, which really puts traditional banking at the cusp of a major disruption. Manufacturing, for example. So 3D printing has apparently solved the problems created by supply chain disruptions across the globe. And of course, our favorite, climate change. Climate change concerns are really deepening with every passing year. And with these concerns, there is a specific spotlight on industries like electric vehicles, renewable energy, sustainable finance, water sustainability, so on and so forth. So the point of this slide is that when we are really talking about investing in the overseas markets, and that too for a long-term horizon, what we are trying to do is to actually stay invested in some of these emerging trends and capture the upside from staying invested for a longer period. But again, does geographic diversification and investing in new age businesses alone deliver returns? Again, let's find out. So this is a slide which has been curated specifically for the Indian investor. Again, what you have in front of you is a 15-year horizon. A dollar invested in S&P 500 would have delivered 152% returns. In comparison to that, an investment in Nifty 50 would have delivered roughly 265% return. So on a 15-year horizon, S&P 500 has underperformed Nifty 50. However, for an Indian investor, investment in S&P 500 would have required converting into US dollars. So which means that today, if an investor would have invested in S&P 500, he is also invested in the US dollar. So over the 15-year period, the returns which the investor is actually making is not just the dollar returns on the S&P 500, but also the returns on account of the INR depreciation. Now, all of us have been reading about, okay, the rupee reaching all-time lows. Rupee even touched the level of 80, in the recent weeks. But question is, what does that mean for a global investor? Particularly an investor who is investing in a dollar-denominated portfolio, the answer is right in front of you. I mean, just imagine that only staying invested in the US dollar, okay, in the S&P 500 index would have increased the investor returns by a 236% over and above this 152%, which is dollar return. So quite literally, this means that a rupee invested in this index would have quite literally grown up to 5 times in a period of 15 years, and that would have outperformed Nifty 50. So with this, we move towards our strategies and the products that we have curated. Now, the funds that we have set up in GIFT City, we are investing only in exchange traded funds. We are not investing in direct stocks or bonds, but we are investing in ETFs. Now, one might wonder that if the fund manager is only investing in ETFs, then why is it that one should actually go to the fund manager? Because aren't ETFs very simple products to understand? Any investor can do ETFs on his or her own, right? Question is yes, but still, let's find out. So what we have in front of you is a snapshot of the entire ETF universe across the globe. Now, ETFs are normally understood as broader market products like a Sensex ETF or a Nifty ETF or a Bank Nifty ETF. But when one looks at the developed markets, what one realizes is that the universe of ETFs is much more layered. Investors not only get access to broader markets and selected sectors, but investors can also invest in specific business themes. And we are really talking about investing in some of the themes that we mentioned in the previous slide, like semiconductors, artificial intelligence, robotics, cloud computing, renewable energy, electric vehicles, lithium batteries, uranium, for example. So through these ETFs, what investors can do is that they can take selective bets on these specific businesses. Next is the regional spread which the ETFs are offering. Now, if you can notice in this map, there are few countries that we have highlighted specifically in dark blue. These are the regions that you can actually take exposure to using only ETFs. And hence, our products, when we are selecting ETFs for our investors, when we are selecting a list of ETFs, what we are offering our investors is a portfolio which is going to invest in some of the best businesses, regions, and themes which we believe will grow over the medium to long term. The question still remains that, okay, we understand that ETFs will give you a variety of investment avenues, but still, why do you need a fund manager? So now the answer is in these yellow boxes. Now today, the market for ETFs is close to $10 trillion. It was $10+ trillion before the market correction. But the number of products which are available for ETFs are more than 10,000 now. And they are listed on more than 45 plus exchanges across different countries. They are investing in a variety of asset classes, including the newer asset classes like bitcoins, cryptocurrencies, carbon credits, special purpose acquisition companies, so on and so forth. In fact, so much information is available for ETFs that investors are really spoiled for choice. So many themes are being made available to investors and they are marketed in a certain way that investors are really confused and they end up dipping their feet everywhere, only to realize that the selection of themes that they would have done would be suboptimal, or maybe the amount of information available is so large that investors are unable to make decision. So that is where we come into the picture, where we are curating portfolios, where we are very carefully analyzing these businesses and themes across the regions, and we are very carefully deciding which regions we want to invest in, which themes we want to stay invested in, versus which of these regions or themes are a wait and watch for us. So that is our value proposition: selection as well as rejection of the businesses and regions to finally make it to the portfolio. So now coming to the specific discretionary portfolio strategies that we have. So our first strategy is the Phillip International Pioneer Portfolio. Now this is a live strategy. So as we speak, we have been managing investor funds under this strategy for the past 8 months now. The focus of this fund is to provide investors exposure to international themes and geographies. The idea is to capture growth stories across emerging innovations and regional developments. The philosophy of the fund, as we've mentioned here, is investing in the trends of today and the ideas of tomorrow. Now, primarily, the fund will invest in equity ETFs, but we have also made a provision to invest in emerging asset classes like bitcoins and carbon credits. Are we investing in these newer asset classes today? The answer is no, but later on, maybe we may consider. One point that I'd like to make about this fund is that while we are really talking about themes and new age businesses, that does not necessarily make this portfolio a technology heavy portfolio. In fact, we are very, very cognizant of the interest rate environment in which we are operating in, as well as the volatility and the correction in technology. And to that extent, the themes and new age businesses that we have invested in are across different sectors, including financial services, including materials, including energy as well. So that is the diversification that we have achieved in this portfolio. The next portfolio is the Phillip International Universal Portfolio. Now, this is a multi-asset product where the objective is to diversify investor capital between asset classes, geographies, and sectors. And the idea is to allocate instruments to ETFs that have varying risk characteristics. So primarily, the fund will have exposure to equity and fixed income, but there is also a limited exposure to REITs, commodities, and currencies, depending upon the opportunities and our view on the asset class. So to summarize our portfolio solutions, what we are offering in GIFT City is global investing through the GIFT City route. At present, through our products, we are investing only in US listed securities. So now I would like to make a very clear distinction that we are investing in US listed ETFs, but that does not make the fund a US focused ETF. So we are investing in regions like, let's say, Belgium, Taiwan, European Union, some nations in Africa, South America. So all these region-specific or region-focused ETFs are traded on the US exchanges. So we are directly buying them on the US markets. We are not investing in different other markets or other currencies. The advantage for the investor is very simple. In GIFT City, we are accepting US dollars as required by the regulations. And we are in turn investing also in products or securities which are US dollar denominated. So to that extent, the benefit of dollar diversification for the investor is maintained. Now I would like to discuss the pillars of our process. So first is a long-term focus. Now in this product, we do not envisage a frequent churning of the portfolio. As we mentioned to you that through our funds, we are really interested in investing in some of these emerging businesses. And hence, we recommend our investors to stay invested with us for a good 5 to 7 years, because that is where some of the high conviction themes which we have invested in, we expect them to play out. Next is that we are following a research-driven approach, and this approach is actually backed by the entire Phillip Capital ecosystem. So as I mentioned to you at the beginning of the presentation, that Phillip Capital has a presence in 16 countries. And as a global fund manager, as someone operating in the Phillip Capital ecosystem, I am actually able to interact with multiple teams across the globe, be it teams in Singapore, Hong Kong, Japan, Australia, Turkey also, for that matter. So what is really helping us is that we are really reaching out to analysts who are giving us on-the-ground insights, and that is how we are offering these insights and creating our portfolio strategies accordingly. Last point is something that we consider very, very important, and that is seamless execution. While this dollar denominated portfolio itself is a new concept, but the entire Gift City ecosystem is an evolving ecosystem. So, with this backdrop, we have really been able to achieve a seamless execution of our strategy for our clients. So, be it the client onboarding process, be it creation of accounts and executing the trades for the clients, the entire journey for our clients is very, very seamless, very, very comforting. Right from, let's say, client onboarding to the end reports that we are publishing to the clients. So, this is a process that has been perfectly established at our end. Now I come to the last part of the presentation, the Gift City advantage. So, as I mentioned to you that we are domiciled in Gift City and I manage this product out of Gift City. But for the larger audience, so Gift City, it is India's first greenfield smart city, which is located in Gandhinagar and very close to Ahmedabad. And it is a city which is envisaged to have a very good state-of-the-art infrastructure. It is evolving as an upcoming financial and IT services hub. And the vision of the government of India is to make Gift City comparable to globally benchmarked business districts. Gift City is governed by a separate regulator, IFSCA, which is the International Financial Services Centers Authority. And the IFSCA enjoys its status as a unified regulator. So what this means is that the funds that we are managing are not governed by SEBI or RBI, but all the regulations come under IFSCA, and that is the regulatory body governing our operations. And of course, the last point, the route available for resident Indian investors is the LRS route. Because Gift City, for exchange control purposes, is considered to be a region which is located outside India. So resident Indians investing in Gift City, investing in our PMS, which is domiciled in Gift City, they will follow the LRS route. For non-residents, there is absolutely no problem. It is, they invest in global markets, they directly come to Gift City, and the process is much more seamless for them. So with this, I end my presentation, and I will be happy to take questions. Thank you.
Right, Mihir. So kindly, stop the screen share so that we can come to the question.
Sure.
So the presentation was very, I would say crisp and clear. But, for the audience
Absolutely.
and for my own understanding as well, I want you to cover in a layman's language what is the, purpose of setting up Gift City, who is promoting it, what are the advantages, and what actually the Gift City is, because you have been working out of Gift City. We have
Right.
been, talking a lot about it. Being a part of Gift City and being, operating out of there, maybe 3 times a week, you would know, more practical aspects around it. So kindly
Yeah.
cover that.
Sure. I think in a nutshell, Gift City has been envisaged as India's doorway to the world, and it has been set up as a very effective inbound as well as outbound investment vehicle. So a lot of NRI investors who wish to invest in India, they can actually access the Gift City route because the way regulations have been structured there, it is much more seamless. NRI investors as well as foreign nationals are encouraged to enter the Gift City route, to invest into Indian markets. Similarly, the second the route which I am operating right now is the outbound part of it. So Gift City has actually been envisaged in a way that Indian investors can now take the next step in their investing journey and invest in global securities through the Gift City route. And the beauty of the entire ecosystem is that while Gift City has its own set of exchanges, but the Gift City regulations do not restrict investor access only to those exchanges. They can directly invest in the foreign market, something which we are doing as part of our PMS through the Gift City route. So it is both an inbound and outbound investment vehicle. Of course, it is promoted and supported by the government of India. As all of you must be aware, a couple of weeks ago, PM Modi himself and the finance minister, so they were in Gift City because we achieved certain select milestones. And because Gift City is being talked about more and more, particularly in the yearly budget. So there is definitely traction. In fact, when I had done meetings in Dubai for a lot of our clients, people are very, very excited and looking forward for Gift City. I mean, the larger objective being that now India also has its own financial services center. If I have to draw a parallel, Dubai has its own DIFC zone, which is a financial services center. There are similar centers in other regions also. So GIFT City is India's first financial services center, which will now compete at a global stage, with all these other countries as well for offering investments. So I think that's about GIFT City.
Sure. So, does that mean that all the PMS and AIF products which are kind of operating, not out of Gift City currently, they would be motivated to kind of operate out of Gift City for certain factors in terms of tax advantage?
I mean, the tax advantage that you spoke about. So, the tax advantage is more for the entities who have set up shop in Gift City. Investors per se, depending upon their domicile, will get or may not get tax advantages. They need to consult their tax advisors. But for tapping in, for example, an Indian PMS who wants to, or Indian AIF wanting to tap into an NRI audience can actually set up a fund in Gift City. So there, the operational procedures are much more simpler for them rather than them coming to India. So that is a route that NRI investors can take. And of course, the local regulations as far as global investing go really did not allow setting up of funds in India under SEBI that can invest in overseas markets. So then the downside of that is investors remitting funds to some offshore jurisdictions like maybe a Luxembourg or a Cayman Islands through the LRS route. But then again there could be a lot of reporting requirements and a lot of uncertainty associated with it. But here, Gift City is India's own, foreign jurisdiction. So while for all regulatory or like foreign exchange purposes, it is an overseas jurisdiction, but still it is within the territorial boundaries of India. So that really gives investors that kind of confidence that yes, they can actually access the global markets through our own Gift City. I mean that is something which is very very positive for investors. And if I can add, this is actually visible in the kind of conversations that I've been having with our prospective clients and wealth advisors as well.
Sure. So, though LRS kind of means liberalized remittance scheme, but can you
Yeah.
please explain the modalities, the limits, and who could avail this, and how is this kind of associated in the context of what you were trying to explain, your product offering?
Yeah. So the liberalized remittance scheme is the framework of RBI, and that comes into force whenever an investor is intending to remit money outside India. It could be for various purposes, and one such purpose is investment in debt and equity, and I'm really going by the form there. So for resident Indians to invest in a global PMS, they need to go through the LRS route. And why LRS route? Because as I mentioned, that Gift City is considered to be a foreign jurisdiction. So investors need to get in touch with their banks and then submit a form A2, which is that fund transfer instruction. And that is how the fund transfer happens. For resident Indians, the annual limit under LRS is 250,000 US dollars. So that is the maximum that they can remit outside India. And this is for all these purposes taken together. So within those limits, they can always look at investing in a global product.
Right. So you had mentioned in your presentation that your product ultimately is a constellation of various ETFs as your approach, right? And because the arena of ETFs is today crowded with so many products, and it is difficult for investor to actually kind of create a portfolio for himself. Your global PMS provides that solution.
Absolutely.
So from investors' perspective, if I put myself in investor's shoe, I would want to understand what is your approach and how will you create a portfolio of ETFs, and what are your views currently on global markets, on various economies, and if an investor kind of gives you an investment mandate for next 5 years, what is the kind of guidance you give in terms of expected returns? So there are three questions, in one.
Surely.
Yeah, sure.
Yeah. So firstly, as you rightly pointed out, that ETFs actually is a huge universe. In fact, slightly digressing from the questions that you asked me, last year in United States alone, there were more than 400 new ETF launches, which means for only in one year 2021, which means that for every trading session, the investor is actually having on an average more than one ETF available each day. So that only adds to investors' confusion because investors would not know where to invest in. So that is where our fund management process makes an attempt to really segregate the entire noise from this universe. We have in place a lot of quantitative filters as well as qualitative assessments through which we are filtering out most of the constituents, and then we are left out with our final universe. A little bit on those filters as well. So for example, we are looking at a minimum fund size for the ETF, or we are looking at a minimum track record for the ETF. And the track record does not mean it has to be a successful track record, but it needs to be in existence in the markets to have demonstrated a significant trading activity. So we look at volumes, for example. Similarly, qualitative assessments also. So there are a few ETF issuers which may be doing very well, but we really don't consider them because they are offering derivative-based strategies, for example. There are certain asset classes that we are not investing in right now. For example, the cryptocurrencies or special purpose acquisition companies. So those are the kind of quantitative filters as well as qualitative assessments that we have in place where we are filtering out the universe. And then, of course, if I have to give a sneak peek into our strategy, so as part of our back testing, we were really working with a lot of data of various country-specific benchmarks. Okay, data ranging from anywhere between 15 to 20 years. Okay, we really applied a lot of mathematical modeling also to analyze some of these returns and risk parameters. So for us, the choice became very clear that we would like to construct a portfolio. In the Pioneer portfolio, for example, we would like to construct a portfolio which is having a US exposure, like a majority US exposure, as well as then an ex-US exposure. And then, so once we've decided on the regions that, okay, we would like to invest so much so in US and then so much so outside of US. So that is where the next step is, which are the sectors that we really want to go ahead with. So, again, that is the kind of analysis that we are doing at our end. As I mentioned to you that I'm a part of the Phillip Capital ecosystem. So while here in India, we have a very strong team of institutional research analysts, interactions with whom does give me good insights about some of the developments in these sectors. But a major chunk of the interactions happen with global teams. So that is where, we really culminate all these insights and then go on selecting which sectors we really want to invest in. Then we move on to these themes. Then again, in these themes, would we really go in for something like a video games, or does cloud computing look good? Or would we like to go in for something like fintech? Should we not consider natural gas because everyone is talking about it? There is a severe energy crisis. Has Russia really bottomed out, for example? So those kind of questions we actively discuss, debate, and deliberate when we are choosing those constituents. And that is how we are constructing the final portfolio. Now, if you really ask me our view on the market, so of course, I think I'll take investors back to the point which I made, that there is something called as a short-term noise, and then there is something called as a long-term view. So of course, the short-term outlook will really, straddle and grapple between concepts like the inflation and the monetary tightening by the US Federal Reserve. Now, last month's inflation was relatively better, and of course, even the markets cheered it. But question is, how long can markets really tolerate an inflation which is still in the range of, let's say, over 8%? So that is something that we'll be closely watching and aligning our strategy accordingly, depending upon how more or less we would like to invest in technology, for example. Again, we are experiencing the effects of a prolonged pandemic by way of supply chain disruptions, for example. So while one view was that by the end of 2022, supply chain disruptions should ease, but nobody really saw these geopolitical conflicts between, let's say, Russia and Ukraine coming. Or nobody really saw the zero COVID policy of China being instituted again and again, because of which massive manufacturing hubs have been disrupted. So those are events that we are watching very closely. Of course, the idea is to really manage them and to avoid certain disastrous sectors. But again, the objective is that we really don't want to be blinded, by these short-term events, because we are really very, very confident and positive on some of these themes that we've selected in our portfolio. And we really believe that some of these themes will start playing out over the next 1.5 to 2 years, for example. So it is really balancing these two objectives, but the focus will always be the longer term picture, because by 2025, 2026, we really envisage that there should have been a massive disruption across industries. In fact, disruption had already started. It is only because of the pandemic that some of these developments did take a backseat. But now that we are looking at a post-pandemic world with so many vaccinations being rolled out across the globe, some of these disruptions and developments will resume, and that is something that we will watch very closely at our end. Yeah.
Right, Mihir. So, what is the kind of advantage in terms of net of taxation returns in your global PMSs versus any other global PMS? Because there are few other global PMSs which follow a similar approach, but
Right.
because yours is having genesis out of Gift City, so what are the objective advantages in that context?
So objective advantages for a resident Indian investors, there are no tax advantages. I mean, the resident Indian investor will be taxed for the global PMS income because that constitutes the global income for the investor. For non-resident Indians, however, there are some advantages wherein investors belonging to countries having a tax treaty with India, so there they can expect an exemption of taxation. Of course, we recommend investors to consult their own tax advisors. But yes, there are a few tax advantages for non-resident Indians, and that is something which investors can consider.
So, with regards to the product offering that we are kind of considering here, is
Yeah.
it only limited to the PMS structure, or you have an AIF structure also?
So right now, I mean, we have our license for PMS only. Right now, we are not we've not launched any AIF product, but of course, I mean, hopefully, we should be coming up with our own AIF offerings soon.
Sure. And though you have covered your view on global markets, on global economies, so we would also want to understand, because your view could be unbiased. What is the view on India's economy, India's capital market in terms of valuations relative to, for example, US, and the guidance in context of this era which is going on, which many other which are India focused fund houses calling as golden era or a golden decade. So how does Phillip Capital, which is a international fund house, and as one of the fund managers view this aspect?
So, well, I think that's a that's a very pertinent question that you asked, and particularly, I think every global fund manager, particularly the one operating in India, should address. I will start your question with the very recent statistic of the IMF, that India for 2022 is the second fastest growing economy at roughly 7.4% GDP growth. That is the latest growth projection for India for 2022. It is behind Saudi Arabia, which stands at 8.2%. And of course, all other economies like US, let's say the European Union and other nations, so they are anywhere between, let's say, the 4 to 7% range. So in terms of GDP growth, we are absolutely right. As a global fund manager, I will say this, that India is definitely one of the fastest growing economy. It is, let's say, growing faster than the developed economies. Question, however, we need to ask is that how strongly is GDP growth associated with or correlated with stock market returns? Because in the previous decade, we saw a major chunk of the returns coming from the Indian market, from the US markets. I'm sorry. But does that mean that we are anti-India? The answer is absolutely not. As a fund house, we are extremely bullish on the prospects of the Indian economy. In terms of, so I can maybe answer this question in terms of investment styles. Now, US is a much more developed market, and there hence the entire demand is more for passive products, because in the US markets, passive funds have outperformed active funds. Okay, in terms of the percentage of funds outperformed, if you see. India, however, remains largely an active market. So US is a passive market, and hence for us it really makes a good sense to actually launched an ETF-based PMS. But India is largely an active market. So, when fund managers are really able to spot the right kind of opportunities, then, for obvious reasons, the portfolio is bound to outperform a US dollar denominated portfolio also. In fact, a testimony to this fact is our own India PMS. As I mentioned to you, our flagship product, Phillip Signature India Portfolio, was awarded one of the best performing funds in the multi-cap categories. So, definitely. So, we are bullish on the prospects of India as an economy. However, when we are looking in the context of global markets, the punt that we are really taking on, rather than the global economy, we are really looking at some of these businesses, some of these themes and regions, which may not grow in proportion with the general growth of the economy, as far as, let's say, the US markets go. Like for example, an area like artificial intelligence may grow much faster than how much the US economy is growing. So our objective is really to identify these emerging businesses which we believe will grow faster than the economy, with of course the assumption and the hope that it will translate into stock market or financial market returns as well. But as an economy, India is indeed very, very robust, very, very strong, faster growing as compared to other developed economies.
Sure, Mihir. So, you have covered that why it makes sense to invest into a global PMS, and what are the advantages and what are the limitations and what is the approach of your style of global PMS. Now, from the perspective of an HNI, ultra HNI investor who is seriously wanting to take the next step, what is the percentage allocation that objectively you would kind of suggest? You are an advisor also, you have cleared your advisory exams, so obviously we cannot hold you for your advice, because this is just for education purpose. And I'm
Absolutely.
giving this disclaimer for everyone, because
Yes.
everyone should kind of ultimately take their own decision. But in that context, and as an endeavor to kind of trying to guide investors who are seriously wanting to kind of take advantage of dollar denominated diversification, what is the kind of right allocation that you would want to suggest?
Surely. So I think this answer will really depend on the investor's risk appetite. On an average, we could say, it could be as low as 5%. It could be even, as high as 20%. What we've observed, however, is, some of these new age investors, so they would like to have more of global allocations also, especially with a lot of these platform based products, which give investors access, let's say to the global markets. So they are willing to put in even 50 to 60% of their portfolio into the global market. So for them, it is like a core satellite approach, if we say. So the core component is actually becoming a global portfolio. Satellite is, some of these India-based funds. Again, depends on the risk appetite. But because you mentioned HNI, ultra HNI investors, and because they really have those kind of resources which they not only want to grow but most importantly even protect. I think a range of, let's say, 5 to 20% should be reasonable for them, because I think that is an average figure that I'm quoting. But of course, please consider the disclaimer that you have made, and yeah, for educational purpose only.
Right. So asset management is ultimately, a business, and I'm sure your eventually the aim is to acquire clients, manage money for them, give them alpha. Now, in the context of business aspiration, what is it that you're kind of trying to aspire in terms of your targets or in terms of your ambitions to acquire assets in your strategy, and what is the target profile of investors? Are the NRI investors which you expect more to be investing into your product, or is it domestic investors? Can you please throw some light?
Sure. So I can't really say, with the proportion of which investors will be more or less, but I can definitely say this. For resident Indian investors, our investment solution is a very, very unique solution. In fact, we are the only fund who's offering a global PMS in GIFT City. However, the limitation which an Indian investor is facing is the upper limit as per the LRS. So there is 250,000 US dollars, So per financial year, the investor cannot remit more than that amount in GIFT City. And of course, investors would have their own, let's say, engagements where they are remitting money abroad, maybe for, let's say, medical treatments and medical tourism or traveling. So that kind of serves as a limitation to them. But for the investors and for their portfolio allocation, the product is very, very unique, and that is what is very, very appealing to them. For non-resident Indians, however, the biggest advantage is, of course, there is no upper cap as per LRS because their money is any which ways located outside India. There, the challenge is at our end because non-residents have access to a lot of other global products. So the challenge and the opportunity for us is really about creating differentiated strategies which will kind of help them invest with us, and of course take advantage of the GIFT City because as I mentioned that a lot of NRI investors also draw comfort from the fact that India has its own financial services center, where they can quite literally get their money and then invest in the global markets or Indian markets. So so accordingly, that is how we are looking at both these sets of investors. Our objective eventually is to, of course, offer services and to enable and empower our clients to invest into global markets. In fact, one of the first lines in this presentation were this only, that today investors are very, very well informed. They are definitely curious about the kind of investment avenues available outside. Most of the investors, the ones at least whom I've met, they are actually tracking global events. Sitting in India, but they are more curious about, let's say, the US Federal Reserve, as I mentioned, or what is happening in, let's say, the European energy crisis, for example. So there is definitely curiosity, but many a times investors may wonder that how is it that they can go about investing, because when there are so many options available to them, where is it that they can take the first steps? So that is where we offer our services to them. They can definitely come to us, and we will enable them to invest in the global markets through the GIFT City route. So yeah, that is our ambition, that over a longer period, this service be made available to many resident Indian investors as well as other investors outside India, not only NRIs but even foreign nationals. We are really passionate about the GIFT City ecosystem, so we are really serving that ecosystem through our PMS.
Right. So though I appreciate the diversification context, the benefits of investing into a global PMS, and that too for NRIs from the perspective of the advantage that your particular PMS offers, it being having its roots from the GIFT City. However, trying to play devil's advocate, because every investor, when ultimately he will take a serious decision of cutting a check of 50 lakhs, which is the minimum ticket size for investing into a PMS, he would want to understand.
To add on, for the global PMS, as per regulation, the minimum ticket size actually is over 1 crore now, and that is as per the GIFT City regulations. So it is US dollars 150,000. Like 1,50,000 US dollars. That is the minimum ticket size as per the regulations. So we just follow that.
Right.
Sorry, your question.
Right. All the more, it's a more serious decision for an investor. So, investor would definitely want to understand that now for next 5 years or for next 10 years, would it really make sense investing into a global PMS when we are, talking about more risks, maybe, in the global context emanating from US. We are fearing that US might be in recession, or, it may have already gone in recession. And on the other side, India's economic growth story kind of, everybody believes in it all the more for next decade than maybe we were seeing in the last decade. So based on the past performance and maybe the bias of past performance, global investing does make sense. But being a very futuristic global investing kind of will be a question mark. Obviously, a large HNI investor benefits a lot in terms of dollar denominated diversification, and eventually he would seriously want to consider this. But definitely this question will come to his mind before he will take a final call. So that is where I could see this, as a thought in the minds of few investors also who are logged in to this webinar. So it's, it will be right for us to cover this aspect. So that is why I wanted to cover this question.
Sure. I think we can answer this question by saying that the decision for investors should never be between global investing and investing in India. So it should never be should I invest in the overseas market or should I invest in India? It should always be a combination of and. So they need to do India-based investing as well as their core, and plus explore opportunities in the overseas markets. So it is always and global investing and India-based investing. So that is number one. Now coming to your question. So yes, I mean there are definitely macroeconomic risks that are emanating, particularly from the way inflation has really panned out, and because of the prolonged pandemic, for example. So again, that is where our product is offering a differentiated strategy in this way, that we are not really looking at broader market exposures. What we are really targeting is some of these emerging trends, themes, and businesses, okay, which we believe will drive the next leg of growth and innovation across different regions. Plus, as I mentioned, that while we are investing in a US listed ETF, like we are investing in US listed ETFs, that does not make the fund only a US focused ETFs. There are certain themes in the portfolio which are actually classified as multi-region, because the regions through which these themes are actually emanating are located elsewhere, maybe South America or even European Union or even Central Asian countries, for example. So there is one particular ETF which is actually driven by a Central Asian country. So that is the objective, that we are not constructing a US focused portfolio alone. We are constructing a global portfolio, which yes, as of now has a majority allocation to US. But even there, our focus is not really to operate at a broader market level, but really make a very conscious selection of some of these businesses and themes which are the next leg of growth. In fact, one point which I missed in one of my previous slides is that when we talk about themes like artificial intelligence or robotics or cybersecurity, these are themes which could be very, very new for an Indian investor. But in the US markets, these are very, very well established businesses. So an ETF of cybersecurities, for example, will comprise of all the top listed cybersecurity giants. In India, a person wanting to invest in, let's say, a robotics may have to invest in a startup, but there you have listed companies who are robotic giants. So through these ETFs, the investor is not only getting invested in these themes, but is also getting invested in the industry leaders of those respective businesses. So that is our objective. Okay, and I hope this answers your question.
Totally. This is pretty clear. And finally, having seen all these questions which have been coming on chat, I think there is fair interest, but there is less, I would say, awareness that investors have with regards to, the possibility of investing into a global PMS, which has genesis, in the GIFT City. And when you said that you are probably one of the first funds, is it really a fact that you are one of the very first funds in this context?
Yes. I mean, if you see, so we are the only ones who've started operations as of now. Of course, there are 6-7 more PMS houses who have sought licenses, but like from what we understand, like we are 8 months into this fund now. So I mean, we can fairly say that. Yeah.
Sure. And from the perspective of HNI investors who would be keen to invest into your product, they have a process in place where they want to understand maybe every month or every quarter
Sure.
how the fund is performing. So, do you guys have that process in place in terms of
Yes.
engaging with clients or sharing the communication in terms
Yes.
of performance, and how will that work? Can you please spend 1 minute confirming that?
Yeah. So, of course, while we have a process where we are disseminating monthly reports to our clients, but we are also coming up with monthly newsletters where we are, discussing some of the major events that happened in the global markets, some of the major events that happened across different asset classes. So there is a process where on the second of every month, we are actually disseminating a monthly newsletter, which we are also uploading on LinkedIn. So, all of us can maybe, like all of you all can maybe reach out to me on LinkedIn as well. So we are publishing those LinkedIn like updates as well. At the same time, whenever there is a major bout of volatility in the market, then just to let's say give investors that kind of comfort as well as confidence. What we also do is that we do publish market notes or market commentaries. So that is not a regular but a periodic affair. But the monthly newsletters is a regular one. So this is in addition to the monthly reports which we disseminate to the clients. We also publish our monthly fact sheets to our clients. So that really gives them a good sense of how overall the fund is doing. So we really assist our investors with all these marketing materials.
Right. So, one of the members from the audience has asked a question that since these PMSs are not controlled by SEBI but IFSC, can you
Okay.
please share investor protection regulations, management fee, lock-in, etc. Whatever you want to cover.
Sure.
Whatever is readily available as of now.
Yeah. So of course, I mean the IFSC Fund Management Regulations 2022 came in, just this year, way back in April, and they really have a detailed framework for investor protection. They govern all these businesses just like SEBI. But the point which we really like to make is that these regulations are not a duplication of SEBI. They have been designed to give the IFSCA a global framework because we really want to replicate, some of these best practices in terms of operations as well as investment protections, which are found in other jurisdictions across the globe. So that is something which is mirrored even in the IFSCA regulations. As far as these regulations go, so yes, there is sufficient amount of investor protection as well. And of course, with the evolving framework, the regulations are also expected to evolve much more, and that will only add to the comfort as well as protection of the investors.
Sure. So, like in any other PMS, which is focused on India, there's a demat account that gets opened, and all the holdings are kind of known to an investor because it
Yeah,
is own person's personal demat account. How does modality kind of and how does transparency in that context work
sure.
in this particular product?
So in this product, okay, like all of those who are already, let's say, doing global investments on their own, would know that there is no concept of demat account as far as global investing goes. So here, what we do is that we have like we do our trades with an overseas broker, and we open our client accounts with the broker, and there all the segregation of assets, liabilities, all the securities and cash balances of the clients happens. So once the allocation is done, what gets reflected and what gets shared with the clients is their individual securities. So I mean this broker is again governed by its own regulations in the country, which require a very clear demarcation of the assets of individual sub accounts, so they cannot be clubbed or mixed together. So that kind of segregation coming from a regulatory requirement itself gives the investors comfort. And that is how individual accounts are clearly segregated from one another. So all the reports, all the contract notes which our investors receive are at an individual account level.
Over a period of time, you get multiple clients, and their timing of investing in your product would vary, and obviously, every time will give you new ideas in terms of constructing the portfolio.
Yeah.
So will all these clients portfolio over a period of time be different from each other, or they will have some kind of a model portfolio kind of a construct, and eventually they will be looking alike?
So I'll say that the client portfolios are indeed alike because we have the same set of constituents across different clients. For some select clients, okay, like for example, clients working in the financial services, they have a restriction on certain ETFs that they cannot invest in, for example. So to that extent, we will customize the product for them. More or less, clients will have the same set of securities. Of course, the changes will be at a time around when we are doing the portfolio rebalancing. Like for example, if we know that after 15 days, certain securities will be exiting a portfolio, so we will not invest. So for new clients coming in, we will not be investing those securities today. Similarly, the process that we follow is that we are not deploying everything on day one. So we are really staggering our investments over a period of time. So to that extent, at different points in time, different portfolios could end up holding different amounts of cash. But eventually, they will have more or less the same securities. But as I mentioned to you, that let's say if it is closer to a rebalance date, like where we are, let's say, changing or reallocating some of the sectors and themes, so there the constituents will be different. and that is how we function.
Right. So last question of this session. I think we have had a very deep discussion about the product, about the approach, about the genesis, and about the differentiation of your product offering. Before we end this webinar, we would want to understand from you what
Yeah.
are your views, on the current risks which prevail in the global markets in terms of inflation, rising interest rates, recessionary fears,
Yeah.
and in near term, if you were to kind of give the house view of Phillip Capital, or you may want to club it with your personal view over next 6 months to 1 year. Obviously, we understand the long term view would be kind of optimistic, but what is the near term view?
Sure. I think the next 6 months, in our opinion, continue to remain volatile, and it will really be driven by primarily the inflation concerns, because last month, okay, inflation numbers were reported lower and the markets did cheer. But question is, the long-term objective of the central bank is to have the US inflation back to 2% levels. So till such time, that is achieved, and till such time we have a definitive, kind of evidence that okay, inflation is indeed heading that way. The market optimism may really not last forever. So that is something that we need to be absolutely cognizant of, because the US has already begun raising interest rates, and depending upon how the trajectory of inflation is moving, the future course of monetary tightening will be decided. As far as a recession goes, the first estimate of the Q2 GDP was already negative, so that technically, or rather, that establishes a technical recession, so to speak. But markets are still looking for more evidence for this to indeed happen. Third is, of course, the geopolitical conflicts between, let's say, Russia and Ukraine. So, how that is really going to pan out, because a major casualty as far as that conflict on the financial markets has been a significant rise in food prices as well as the natural gas. So, energy prices and food prices, the ones which drive a major chunk of the CPI, for example. So because of those rises, so if geopolitical tensions are easing, and if again there is a reduction in these prices, of course commodity prices have softened quite a bit in the last couple of months. But we really need a definitive trend, because again there are a few views coming in that this reversal in commodity prices may again not last for long, and there could be another 15 to 20% rise in the prices of commodities. So those are some of the trends that we are actively monitoring in the next 6 months. Having said this, we would say that the markets are extremely volatile. The opportunity for us, especially our investors, is that even though, let's say, since July the markets have been recovering, they are still nowhere near to their all-time highs. An investor investing today will still be investing in a market which is down anywhere between 15 to 20% from its all-time high as far as the US markets go. So that is an opportunity, of course, for a longer term period. In any case, the price doesn't matter. But here it is just like an icing on the cake. They can definitely enhance their returns over a longer period. So these are the trends that we are observing. One other trend which I mentioned in the earlier part of the presentation was also that we will really have to see how the supply chain disruptions are easing out. Because if there is a zero COVID policy, for example, or if there is an escalation of tensions between China and Taiwan, then how the semiconductor space will be impacted, and because of which, how will the electronics goods, smartphones, electric vehicles, for example, will be impacted. Those are things that we are monitoring very, very closely for the next 6 months. So again, the conclusion being that markets continue to remain volatile for the next 6 months, and a staggered approach is recommended for building long-term positions.
Thank you so much, Mihir. And to everyone, before we kind of conclude, I would just like to add that the product that we were talking about is a PMS structure. And, for doing offshore investment, the PMS structure works different than a domestic focused PMS. So anybody, who is keen to know more about this particular product or this particular structure or the approach, being followed by Phillip Capital, you are most welcome to write to us. You can book your call by going on to pmsaifworld.com, where India's most trusted platform, for HNI and ultra HNI investors, managing more than 400 HNI and ultra HNI clients all over India, even overseas, and serving them, with best of our knowledge and abilities. And we can assure you and very confidently convey that you will be kind of very satisfied with our services. Thank you so much for joining us for this webinar. And I think, the way Mihir has concluded, he wants to convey that the recent rally that we have seen in July looks to be a bear rally, and which basically means that the opportunity may come soon for those investors who have missed participating in this bear rally. And hence, it is a kind of a optimistic context for long-term investors who are wanting to kind of, participate into the long-term futures of equities and asset class, whether it be a domestic focused fund or a global fund, is a matter of your personal choice in terms of how you want to create a diversified portfolio. Your own advisor can do a good job in terms of constructing that portfolio for you. We also do that work for a lot of our clients. You are more than welcome to write to us, to connect with us, to help you in that regards. Thank you everyone once again.
Thank you so much, everyone. I think the questions were indeed very, very engaging. It really gives me the confidence as a presenter that I think the points that I really wanted to present have been conveyed loud and clear, if I may add. So thank you very much again. Thank you, PMS AIF World, for this lovely opportunity. And really looking forward to